What's up, future CPAs? Welcome to the ultimate study guide. If you're tackling accountancy, you're exactly where you need to be. Today, we're cracking open the playbook on one of the biggest topics for the LECPA, stocks. And look, this isn't just about cramming facts for a test. This is about building the mental muscle you'll use for your entire career. So, let's get into it.
Okay, think about this for a sec. You buy a share of stock. Cool, you own a piece of a company. But what does that really mean? What do you actually hold in your hands, or, in your trading app? It is way more than just a number on a screen. It's a package deal of rights, responsibilities, and, believe it or not, real power. Getting that is the key to unlocking this whole subject.
All right, here's our game plan. We'll kick things off with the building blocks, the different kinds of shares. Then we'll talk about how you get them, what happens when things go south, and the awesome powers you get as a shareholder. Oh, and definitely stick around till the end. We've got a super fast bullet review to lock all this in for exam day.
First things first, your building blocks. Look, you can't win the game if you don't know the pieces. And in the corporate world, the pieces are the different types of shares. Each one has a totally different role and a different kind of power. Let's break them down.
So let's start with common shares. Think of these as the bedrock, the foundation of the whole company. Common shareholders, they're the true OG owners. They take the biggest risk, right? If the company folds, they're the last ones to get paid. But they also get the biggest potential reward. And, most importantly, the full power to vote and decide where the company's headed.
Now, on the flip side, you've got preferred shares. If common stock is the foundation, preferred stock is the VIP lounge. These guys get special treatment. They get their dividends paid out first, and if the company liquidates, they get to cut in line ahead of the common stockholders. But what's the catch? Well, that VIP pass usually means you have to check your voting rights at the door.
And beyond those two big ones, you've got these specialists. Founder shares? They give the original creators special voting powers, but only for up to 5 years. Redeemable shares come with a built-in buyback button for the company. And treasury shares? They're like boomerangs. The company issued them, they were paid for, and then they came right back to the company. These three are total exam magnets, so keep them on your radar.
Okay, screenshot this. Seriously, this chart is pure LECPA gold. It all boils down to one thing: power versus priority. Preferred gets priority with the money. Common gets the power to vote. Simple as that. And don't forget that little detail at the bottom. It's a classic trick question. Preferred shares must have a par value.
All right, so you know what the shares are, but how do you actually get them? It's not like adding something to your shopping cart. It's a formal process with very specific rules of the game. So, everything starts with this, the subscription contract. This is your official ticket to the game. It's the legally binding deal you make with the corporation to buy its unissued stock. The second you sign this, you're on the path to becoming a shareholder.
And what's valid currency for that ticket? Well, cash is king, obviously. Property works too, but the one you need to highlight in your notes is labor or services already rendered. The keywords there are already rendered. Work you've already done for the company? Totally fine. A promise to work in the future? Not gonna fly. And that brings us to a huge flashing red exam alert. You need to burn this into your brain. You can never pay for stock with a promise, not a promissory note, which is just a fancy IOU, and not with the promise of future services. I can almost guarantee you'll see a question that tries to trip you up on this. Don't fall for it. Okay, we've covered how to play by the rules. But what happens when someone doesn't? Let's talk about the penalty box. This is what goes down when shares are issued the wrong way or when someone just plain doesn't pay up. First up, this thing called watered stock. And honestly, the name is perfect. It's like you order a really strong coffee, but the barista secretly fills half the cup with water. It looks like a full coffee, but it's weak and diluted. That's exactly what watered stock is. The company pretends the shares are fully paid for, but they actually got less than what they're worth. It's a total ripoff to creditors and other investors. So why is this so illegal? You need to know two main theories for the exam. The first is the trust fund theory. It basically says a company's capital is like a trust fund that's supposed to protect its creditors. Watering it down is a breach of that trust. The second one, the fraud theory, is even simpler. It's just fraud. The company is lying about its true value.
So who's on the hook when this happens? The law is super clear. Both the director who okayed the deal and the stockholder who got the shares are solidarily liable. Now that word, solidarily, is huge. It doesn't mean they split the blame 50-50. It means creditors can go after either one of them for the full amount. It's a big-time accountability measure.
Now what if a subscriber just ghosts on their payment? Well, it's not just a reminder email, it's a whole formal process. The board has to pass a resolution, they notify the person, publish a notice, and then the shares go to a public auction. And here's the wild part, the part you need to remember. The winner isn't the highest bidder. It's the person who agrees to pay the entire debt for the smallest number of shares.
All right, enough with the penalties. Let's talk about the good stuff, your shareholders' superpowers. Being a shareholder isn't a passive sport. You have actual rights, actual power, and knowing them is key. A really good study hack is to break these rights into 3 buckets. First, management rights. This is your power to have a say, to vote. Second, proprietary rights. This is all about the money, your right to dividends and a piece of the pie. And third, remedial rights. These are your fight-back tools, your right to see the company's books and to sue if things get shady. And probably the coolest remedial right is the derivative suit. Now check this out. This is where you, a shareholder, sue someone on behalf of the corporation. It's like the board of directors fumbles the ball and you step onto the field, pick it up, and run with it. You're not fighting the company, you're its champion, fighting for it.
All right, team. This is it, the final huddle. We've gone through a ton, so let's boil it all down to the absolute must-know facts for your exam. If you remember nothing else from today, remember these next few points. Let's lock them in.
Takeaway number 1, common shares always get a vote, period. Preferred and redeemable shares, yeah, they can be made non-voting. But common stock is the basis of ownership, and it always comes with a voice, no exceptions.
Takeaway number 2. Remember that word, solidarity. For watered stock, the director and the stockholder are both 100% liable for the entire missing amount. Not 50-50, 100%. They're in it together completely.
And takeaway number 3, and this is the kind of tricky detail they love on exams. A delinquent stockholder, someone who hasn't paid up, loses their right to vote. That's suspended. But they are still entitled to dividends. The catch is, those dividends just go directly to paying off their debt.
And that's the playbook. From the basic types of shares to your ultimate superpowers as an owner. You know the rules, you know the risks, and you know your rights. You're not just ready for a test, you're ready to be a real player in the business world. Now go ace that exam.